Okay.
Sure.
So are we ready to start?
Yeah, let's just give it one more minute here, and then we'll be right on time. Let me just close one screen here.
Mm-hmm.
Okay. Good, Shuva, you're there. I saw you as well. Yeah, I see her. There she is. Okay, good, great. Well, then let's go ahead and get started. So, I see we have 20 people in. So that's great. So, welcome everyone. Here we are for our third session now, making great pace. Again, I'm dialing in from the U.S. where we have been for the last couple of weeks. It's been a great holiday here. So basically, in this third session now, we're going to start to turn towards financing, as has come up several times. Maybe Naveen, you want to mute everyone except for me because there's a little bit of feedback there.
Mm-hmm. Okay. So mute all.
Yeah.
So I have muted all, and I think.
I just unmute myself. Perfect. Great. Thank you. Good. So I was just saying, we move in this third session as the design of the course is really to now start to address financing head on, which, once we've gotten over some of the understanding of the regulatory and technical issues, really we start to deal with a game in renewables, which is a lot about cost of capital. And clearly what has come up already in the discussion is that you've got a structural difference in India associated with higher central bank rates, higher inflation, which drives higher central bank rates. So there's a certain portion of this which is really unavoidable, that the opportunity cost of capital is going to be structurally higher in an economy where you have higher interest rates. That said, given that these assets will perform much better on a cost basis, if you can bring down the cost of capital, one of the challenges, not just in India but in a number of markets, has been how do you use concessional finance that's available through the development banks? How do you open up certain channels for financial flows from other countries in a way that would help structure projects in a way to achieve the greatest benefit possible? And clearly the benefit there is loading in a significant volume of debt at a lower interest rate than would be available. So that's really the kind of what we want to dive into in this session. We're really fortunate to have a couple of guest speakers here who are deeply knowledgeable about both the multilateral side, and we'll hear about some of the funding programs instituted by the World Bank, and then also how the banks and developers have been looking at creative ways of structuring both offshore and onshore in order to bring in foreign sources of capital. So, this will only probably become an issue for those folks that are really thinking about setting up their own projects or somehow becoming a principal to large-scale projects. If you're just procuring, then clearly there's not an asset to be financed. But understanding this part of the chain, the asset financing piece, is really key. And so I think it was well worth it to spend an entire session on this, even though for some folks that are looking at this, there may not be as much of a direct driver into the way that they're thinking about going about their strategies. So with that, let me turn it over to Naveen. Thank you again for joining, and we'll go ahead and get started. Naveen.
Thank you, Charlie. Thank you, and welcome everyone. Welcome to the third live session. And as Charlie said, this session is completely focused on financing, and the module that you would have seen is also primarily about financing, and it talks a lot about the WACC, where Charlie talks in terms of how coming to the right number is actually not just about finance. It's more like an art. It's all that. So we have two very, very, very distinguished speakers. I have Vikas Bansal here, who's actually an alumni of this course. He was a part of the previous cohort, and he used to be with Yes Bank earlier. used to handle infrastructure finance, and he's got about over, like, I think, 12 years experience in financing structured products as well as project finance. And now he is with Azure Power, which is one of the reputed foreign investors in the power sector, and has about, I think, over 3 billion of assets in India, and probably like gearing up to do some more. So he's going to talk more about that gradually, and the conversation with and his presentation is going to be more in terms of conversation style. So I would request all of you to actually post your questions on the chat, and we can basically, like, he can kind of start respond to those questions while he speaks. But first, we are going to start with Mr. Dr. Amit Jain. Dr. Amit Jain is a senior energy specialist from the World Bank. He's a notable scholar. He's also he's a PhD in solar energy, a Fulbright scholar, and a Chevening Fellow. He's authored 2 books on climate change policy as well as waste to energy. He's authored a couple of articles which are published in journals. He is also he's also heading a 2 billion renewable energy facility, which is primarily like in the Indian subcontinent. So he's going to be touching upon the multilateral financing part. So without taking too much time now, I'd request Dr. Amit Jain to kind of start off with his presentation. So Amit, over to you.
Hi, good morning, good afternoon, good evening. First, I want to make sure that you can hear me clearly and you can see the screen of the presentation. Naveen, can you confirm that?
Yeah, it looks fine. We can see the screen and the first slide really fine, and can hear you. Okay, we can hear you. Yeah, hear you fine.
Okay. Thank you very much, everybody, for joining. First of all, I was being told that the cohort for 2019 are senior officials, but with medium to low level of knowledge of renewable energy. But when I looked at the participants from Ambuja, Bloom Energy, BSES, Godrej, I think these are all agencies and the people who have significant stakes in the renewable energy. So I will do both a bottoms up and a very bird eye view of renewable energy and solar rooftop in particular, to give a very broad view on where things are going in renewable energy and solar rooftop in general. Now, very briefly about myself. I'm Amit Jain, and as Naveen mentioned briefly about my profile, but let me tell you, I belong to a very small town called Patiala in Punjab. So when I was growing up, and I belong to a very middle class family, when I was growing up, my father told me that there are 3 important things in life which you have to meet to survive, which is called roti, kapda, and makan in India, which is clothing, food, and a house. He was very obsessed with the house in particular. And when we were constructing the house, he spent a lot of time on the roof. You know, we had a kitchen garden, we had a very beautiful railings. So I asked my father, why would you spend a lot of money on the roof? He said, just wait and watch. So when I grew up, I ended up spending a lot of time on the roof. I was playing kites, drinking beer with my friends. My mother was growing mango pickles. So we got an emotional and a cultural touch with the roof, you know, which is very difficult to break. So if tomorrow Vivek, now who is with Azure Power, if he comes to my father and says, I want to install a solar plant on your roof, you will save X amount of money. The payback will be 4 years. I'm sure my father is going to say no. The point, the message which I'm conveying to everybody over here is, while finance is very important in India, there are a lot of features outside finance which play a very important role. Solar rooftop in particular is a factor, a criteria in that, and Vivek probably would agree with me on that, because Amplus has started a new product on residential solar, in which there has to be an emotional and cultural appeal to the local household to convince them to install a solar plant on their rooftop. So that's the background. We are going to work on that. A little bit of history. If we go to 2010 and 2016, many of you know that when Government of India announced our national solar mission, a huge target of 100 gigawatts was set, out of which 40 gigawatts were set only for solar rooftop. While solar parks and utility scale solar was becoming successful, solar rooftop in particular was still facing a lot of challenges from the market. If you see, in the first 6 years, India only installed 500 megawatts and mobilized only $500 million. This was partly like companies like Azure Power, first of all, could not raise debt from the market. Even if they raised debt from the market, it was available at 17%. Huge, high interest cost as compared to what you can get for solar parks or even for other large scale solar projects. So in 2016, we partnered with State Bank of India, which is the largest bank in India, and we launched a facility of $625 million. After this facility was launched, in the last 3 years, this facility has been very successful. We have seen that a lot of commercial banks, like including Yes Bank, Ratnakar Bank, ICICI Bank, PNB, they have launched their own credit lines, replicating the World Bank SBI line. We have also seen that players like CDPQ has invested in Azure Power, and also companies like Shell Foundation has invested in clean tech. So a lot of private equity and international finance have started coming to solar companies in India. And if you see the chart, the interest rate has fallen from 17% to 9%. So if a company goes to SBI, they will get interest rate for a solar rooftop at 9%. So you see a fall of directly of 8%. And Amplus is one of the leading players which has taken a loan from the State Bank of India. So in the last 3 years, from 2016 to 2019, we have mobilized more than $4 billion, and India has installed almost 4 to 5 gigawatts of solar rooftop. We expect State Bank of India will launch its own product and match the financing which we have given them. And but by this, we expect that by 2022, we will be able to meet the Government of India goal of 40 gigawatts and mobilize $35 billion. When we started the program 3 years back, we started thinking of what are the different challenges faced by the market. Now, let me clarify here. The example I'm giving you is solar rooftop, but this is true for several renewable energy projects, including solar and wind. So 3 to 4 years back, either the debt was not available for solar companies. Even if it was available at a very high cost of capital, about of 17%. If you look at India, India is a federal structure, as you know very well, and electricity is a concurrent subject. While the central government can make rules and regulations for power, but the states have the authority either to implement them or not to implement them. In the solar rooftop in particular, we noticed that although Government of India has a net metering regulations, but every state has its own regulation which did not match the central regulation. So for an investor like Amplus, they got confused that if they design their business plan for a particular state, they had to customize that business plan for a different state. So there was a mismatch between the 28 states in India. Skilled manpower was missing on the ground for operation and maintenance. There were no standard legal documents. If you look at the PPAs, the roof rights, all the states have their own documents, which sometimes are bankable and sometimes are not bankable. Now, if you want to install a solar rooftop plant on your house, you could install a 3 kilowatt facility to a maximum of 10 kilowatt facility. Now, these are very small plants. If you go to a bank to get lending, or if you go to an investor for upfront cost, the transaction cost and time required for these solar rooftop facilities is very high. So if I'm a manager, I would be resistant to do a 2-3 lakh facility with you to install a solar rooftop. So a demand aggregation was required in the market to aggregate these projects and take it to a bank. And that's what, again, the SBI facility is doing through RESCO players like Amplus. As I started my presentation, awareness campaign is required on the ground to convince the households that it's not only that money which you make. solar rooftop plants makes you independent of the power in India. We all know that there are blackouts and brownouts in all the major cities in India. A solar rooftop plant could help you in assisting independent in making a power generator. Finally, the demand aggregation was not happening. Now look at what has happened in the last 3-4 years, which we are trying to replicate in all the states in India. The cost of capital has fallen from 17 to 9%. We have partnered with Green Skill Council for engaging training programs on the ground. I suppose there is also a cohort from Green Skill Council. So we are working with Green Skill Council and SECI and others to do that. We are working with 17 states in India to install unified web portal. This is like a website where you can transact, you can log into this website and you can order a system online, and you can install the system on your household on a single website. So this is a single transaction portal for 17 states which you're working in. This is to reduce the transaction cost and time. Then a standardized tender document has been circulated by MNRE with the help of World Bank and SBI. We have started demand aggregation in several cities in India. And Madhya Pradesh and Delhi are the two models which has been very successful. We are launching a media awareness campaign with MNRE, which includes Facebook, which includes video, radio jingles, and so on. We have already done that in Madhya Pradesh and Delhi. We are expanding to all the 17 states. The net regulations has been updated by the central government, and we are replicating that in several states in India. And solar rooftop policies have been installed in different states. The point here is, yes, the financing was important, but it is only a piece of it, at least for the solar rooftop. The ecosystem for solar rooftop was completely missing from the ground. And the World Bank with State Bank of India is working on policy, regulatory, awareness, all the other campaigns to make sure that it takes off. And we have seen the results in the last 3 years. I must tell you that SBI played a big role in making this program successful. Because first of all, SBI has more than 22,000 branches in India. So the reach of SBI is much more. Of course, World Bank has only a branch in Delhi and Bombay. But with the partnership with SBI, we were able to reach the nook and corners of the India. Let me tell you briefly, we were in Andaman Nicobar. We could not find a coffee shop, but we were able to find a SBI branch over there. So that's the kind of reach they have. 250 million people in India have accounts or a user base with SBI. So SBI reached out their own clients and do a top-up loan on their existing projects to do a renewable energy portfolio. So that becomes easier to reduce the transaction cost and time. And we are launching and innovating several models with SBI in this regard. You know? Finally, I would like to say that in the past 2-3 years, the cohort should know there are several things happening on the ground, which is giving a lot of issues to the renewable sector in particular. For example, if you are closely watching in Andhra Pradesh, a government came into power which is practically saying no to all the projects of the previous government, which is the Naidu government. So they have put on hold all renewable energy projects on hold in Andhra Pradesh. Now this is sending a negative signal not only within India but also outside. So the external investor is now thinking, if a state government can do this to existing projects and the old projects, we cannot trust now India. So this is giving a lot of jitters to international and local investors. The safeguard duty put by Government of India also is now confusing the players that whether we should wait or we should invest for these projects right now. Similarly, GST also kind of stopped the renewable energy takeoff over there. So I would say government has taken some backward steps in the last 3 to 6 months, which is giving the scale of the renewable energy projects a stiff challenge over here. I will stop here and will entertain any questions if required. Thank you.
So Amit, there's quite a number of questions that are coming in there on the, and I'll try to summarize I think a couple of the basic themes there. One is that at some point when you get a substantial flow of power onto the grid from the rooftops, it becomes very challenging for the not just the Discom in India, but any utility that's unprepared for that starts to encounter real problems with large flows, particularly if those occur in off-peak times and then a draw during peak times. So, we've seen Germany really struggle with that. We've seen both E.ON and RWE were pushed nearly to bankruptcy as a result of what became zero and even negative power prices in the German wholesale market as due to a lot of embedded generation. What's been the thinking about how the bigger deployment of rooftop in India can potentially avoid those problems, or is it going to have to come down to more storage on the generator side in order to essentially firm that power and make it dispatchable?
Thank you, Charles. Let me divide your question in two parts. First, the Germany example. So what happened in Germany, the solar rooftop or the solar revolution was backed by feed-in tariff. They gave expensive feed-in tariff at the tune of 17 euro cents to the players back in 2009. And because Germany was the first bird and the solar was expensive at that time, that's the reason utilities got bankrupt or there is a zero pricing on solar, because the power was very expensive. However, in India, we don't do FIT. We never did FIT. We started with reverse auctions in solar park, and we have reverse auctions now even in solar rooftop. Even in solar rooftop, we have prices of 4 to 6 US cents, which is cheaper than coal. So the question of bankruptcy does not arise. I usually say that if the credit for solar revolution in the world, it goes first to Germany and then to China, because these are the two countries which has helped countries like India to build on the knowledge which Germany created and the manufacturing which China is doing over there. So the question of bankruptcy to DISCOMs does not arise, because DISCOMs currently have long-term PPAs which are more expensive than what solar can give them. So that's the point number one, Charles, you raised. Now, secondly, grid stability. India has two options if we want to go for 100 gigawatt solar. First, we do utility scale solar parks like we did in Bhadla or we did in Reba Solar Park, where you have 750 megawatts or 3 gigawatts of solar at one place. Just imagine in a desert very far from a demand center which is generating 3 gigawatts, how will you transmit that power from that solar park to Delhi or to other places? First of all, you will require an extensive transmission network. Secondly, the T&D losses, the transmission and distribution losses, will be huge. So this is one part. Look at the solar rooftop. If I have a solar rooftop on my house, I will consume 70 to 80% of my power internally. There is no transmission network required in terms of transmitting to the grid. If I transmit 10 to 20% of my power, I can use my existing transmission by a good inverter over there. So grid stability, in fact, is being helped at least by solar rooftop, because it reduces transmission and distribution charges, plus it is generating power where the demand is.
I suppose I agree with all that. I suppose the challenge starts to come when you start to see and I've not personally seen any studies of this yet on the Indian market, but where you start to see, California does a lot of work to publicize what has been now called the duck curve, where you get, midday, you get a large flow of power from distributed sources. And basically you get, and then that peak comes on sort of as soon as early evening occurs. A lot of the solution to that in other markets has been thinking about demand side response, has been thinking about how the electric vehicle system starts to play in to sort of levelize that back out. But curious whether there's been, at a technical level, there's been much exploration of how solar is already starting to change the load curve within regions?
Yes. So that's where, Charles, I think the storage will play a role. Currently, with the low penetration of solar rooftop, I don't see a challenge in grid stability. But as we move forward towards a deeper solar rooftop penetration, the storage prices are also falling significantly, as you know. So in the coming years, we would see a natural integration of solar rooftop with storage, which will take care of the duck curve problems which California is facing.
Mm. Good. There's a lot of good, very interesting comments here on the chat, and I think what maybe rather than trying to get to each and every one of them, perhaps invite Vikas to give his presentation. There's going to be some small issues that come up, but I'll just say though, for the folks that are looking specifically, there's folks talking here about how net metering needs to start to perhaps start to change in order to become a bit more of a dynamic system. These are things that as you're putting together your presentations, we're really happy for you to include some of these ideas in the way that you articulate how a company could become a much bigger consumer, either through traded products or through actual on-site generation, because as of today, clearly there are going to be issues that come up that make people reluctant, as Amit said, whether that's an emotional issue or whether it's just simply seeing that there are some uncertainty going forward. So really would encourage folks as you get into now discussing with your groups how a specific user would adapt to some of these policies, to think about things that would be necessary or specific policies that would enable the kinds of asset financings that you would be recommending, or procurement plans that you would be. So all of this good creative thinking here on the chat really would encourage people not to lose sight of that, because we are definitely trying to think about the future of the system, not just how it stands today. So again, rather than probably go through each and every one, maybe invite Vikas to share with us his thoughts, and we can come back to some of these issues as we go forward.
Sure. Thanks, Charles. Can everyone hear me?
We can hear you fine. Yep.
All right. Okay. Yeah. Hi all. Thanks Amit for this interesting presentation and the time frame in which we have progressed from 2010 to 2019 today as we stand, and the way a place like World Bank has helped the rooftop strategies for India. I've been in a very small fashion. I've been a part of this journey since 2011. I was with Yes Bank and have seen, how a private sector bank and a relatively newer bank on the frame could target an industry like this, which was upcoming, which was promising, and so I was fortunate to be there at that time in the bank. So, and from the private sector bank side, Yes Bank took the lead in terms of financing solar projects, wind projects, and took the mantle forward in engaging with the regulatory authorities, with the ministries, and with the players like World Bank, other DFIs, to encourage progress in the industry. So very brief is available on slide for my experience. I've been all through in the banking industry. Just recently, I've shifted to the business side. I've now joined Azure Power, which is the major solar developer in the country, and have a portfolio of more than 3,700 megawatts, which includes around 250 megawatts of rooftop also. So it gives a fair mix of balance in terms of solar projects with the company. So I've recently joined, and I'm kind of trying to understand how business is moving in this company. And in the short time I have understood one big aspect that most of the rooftop development that has happened in the country has happened on the commercial side, basically the commercial and industrial players who have taken benefit of rooftop and the offerings from the rooftop players available in the industry. The residential side, as Amit was mentioning in the beginning, that there is a lot of other factors involved apart from financing and apart from economic and the number sense, which is actually restricting the adoption of rooftop in the Indian residential sector. I believe as we go along, as we present more opportunities to the consumers in the rooftop space, I think it will. If not sooner than 2020, I think people will start accepting it, and people will see that what kind of benefit is there comparatively when they see the grid versus the reach of the grid and the cost of the grid power versus the off-grid rooftop systems on their roofs. So I mean that's a brief background on that. I had very few points to actually discuss, and I just wanted to put some light on how the financing moved in this sector and what kind of sources were available to the developers when they were starting in, and what kind of structures I saw as part of the lending as part of the lending side, and what kind of structures are currently available when I'm part of the business side. In the Indian market is fairly accessed capital from all sources, I think, which was available, and partly with the help of the international DFIs, which have participated in the Indian industry financing. And that has encouraged commercial banking space also to actually pitch in. I saw in the beginning that not many PSU banks were very eager to actually either initiate or participate in the financing for renewable energy projects. But lately, since 2015 and 16 period, with the support of IFC and support of World Bank and other European DFIs, most of the public sector banks have also come into the picture, and they have given a lot of support to the developers in providing financing at the fairly lower cost of capital, cost of debt also. Amit was very right when he mentioned that the cost of capital earlier was very high. Even the debt costed around 14 to 15 or 16% also that time, while the benchmark index was not that high. It was around 11 to 12%. So the spread on the benchmark indexes were very, very high that time. And now that we see the spread for the industry, particularly for rooftop, is not more than maybe 200 bips at max. So that's a kind of growth we have seen, and that is because the various sources of finances were available to the developers. So people like Amplus and CleanMax and other rooftop developers, including us and Azure, we have tapped the rooftop market. We have tapped the rooftop business, even when the debt was not available like the way it was available for the utility business. There were a lot of investors available. They could understand the business potential. They could understand the business sense, and with their support, the business went on. There were a lot of rooftop bilateral deals that were taken off in terms of PPA negotiations, in terms of guidelines which MNRE opened up in terms of standardizing documents, which helped in terms of closing bilateral agreements with the commercial players. Lately, after 2016 and 17, when national aggregators like SECI and others came into the picture, I think this whole potential for rooftop at government buildings and government authorities buildings and railways and all these places, it actually opened up, and it opened up the opportunities for larger players like us also to participate in the fairly transparent open tenders and had a good sense of understanding where the assets has to be placed, which were not available earlier, which involved a lot of time and effort at the developer's end to actually identify and zone in on where to put the investment. So it actually reduced that initial timeline and initial costing, and it helped people participate with capital in place. So that is also one factor where we've seen investors as well as commercial lenders getting interested in financing of commercial rooftops, solar rooftops. The one model which I can see, how it has been able to garner financing for us also is the pooling of assets under the openly bidded projects of SECI and Government of India. So we've been able to pool some asset classes and carry on work on that basis, which there is commercial financing which is available for us on that, and that too at a very fairly good cost of debt. And I think that is the way forward. That if developers have to take on this potential of rooftop in their country, I think the pooling of assets is one way in which maybe some kind of a sacrifice in terms of the returns has to be accepted while putting in the upfront capital, but the asset development and then pooling of asset for attracting financing, maybe during the course of construction or after the construction of the asset, that will be a good way to actually build up large portfolios in rooftop. Similarly, for the buyers, when we call solar rooftop consumers or buyers, I mean, if there are a lot of national level companies and national presence companies which are actually seeking to take benefit of rooftop contracts with the developers, and I think this will be very beneficial in terms of increasing the rooftop portfolios at various states level and cities level. I'm seeing some questions on the chat. Maybe we can take up the questions also.
Yeah. So maybe let me ask a question, Vikas, and then I'll maybe get into a couple of the issues that are coming up on the chat. So, in a market that you're familiar with, the U.S., we have there was a model that around rooftop that really accelerated. Which was really for the developer to step in and basically own everything, and then handle pretty much, essentially remove all the risk for the host, for the person with the roof, and be basically selling them back power, and all the risk management, all the financing was being done by the developer. Of course, that is still happening, but it hit a big. I think that the risk of that business model really took a hit with the bankruptcy of SunEdison and the subsequent decline of some of the interest of the banks of putting that through. So maybe you could just talk us through a little bit. What you talked about some different models for which developers can get involved. Is that kind of third-party leasing model going to be relevant for India? Are there other models that might work out in which basically the customer can have most of the financing and risk management activities taken care of for them?
Yeah, sure. So no, I think the current model which is going on, where national entity like SECI is aggregating demand from the commercial rooftops, commercial buildings, and commercial buyers, and providing a one-stop solution in terms of a fair and transparent bidding, standard documentation, standard criterias, and and assuring that the selection which is happening through that process is viable and feasible. I think that is a correct way of going. At least in the current period, where people are, kind of, I can say, not very aware of the lifetime cost of a rooftop system. Of course, the grid is already connected to these places. these rooftops, and the economics of how it is costing for them vis-a-vis the rooftop systems which may be available and what kind of support it can provide, one physically and in terms of it, the costing economics. I think that is required to be done, and that is what is being done fairly with this large tenders being done by SECI. The only part is that after the tender is done, the SECI's or the aggregator's role is finished, sort of, and that the contractual arrangement is then between the bilateral parties, and they have to manage how the operations are being monitored on the project. So I think from contractual perspective, from initiating the project and developing the project, the current system of aggregation of demand through a national agency, I think this is the best way to get comfort at both the ends.
And there's another question here, maybe that I had in my own mind as well, which is talking about where lenders are getting involved. With the utility scale projects where they've come through a tender and you have a guarantee from on the PPA. That's a very clean model that every lender can understand. When you get into the rooftop sector, it gets a little trickier. Particularly as PPAs get shorter, there's a lot, outside of India, there's a lot of talk, at least, going on around how banks will deal with taking merchant exposure or having uncontracted revenues towards the back end of projects. So maybe you could just address that a bit. How are lenders, reacting to financing of assets where it's outside of the sort of the long-term government-backed PPA and something maybe more short-term, more corporate, or something that is securitized on a kind of an aggregated basis rather than against a single name?
Yeah, no, I mean, that kind of a concern would have been true at least 1.5 years back, when people were not even opening up to discuss on the private PPAs. If the PPAs are not with DISCOMs or the central government entities. But I think with the large portfolio now already built up with the rooftop developers and the way it is operating with some operating performance data which is available, and with the credit strength which is available to be seen of the off-takers, I think few lenders are actually keen to actually discuss on financing those private PPAs also. As I said, pooling of assets is actually what is attracting them, because it is firstly it is giving a good size for them to evaluate, and and secondly it actually diversifies the risks. And when we say that we are more comfortable with the government-backed PPAs or DISCOMs PPAs, even when it is seen that their financial strengths are not as strong as the private counterparty with which we may have PPAs. So when it is a part of a pool, a bigger pool, I think, and then that pool is kind of operational for some time, and either some part of that pool is operational and some part is actually being developed. So a lot of keen interest is visible for financing of that. I can inform to the group that at my company level, we have a good sort of pooled asset base, which has attracted a lot of interest from the lenders, and we are kind of exploring that commercial finance option.
Mm-hmm. Good. There's also a question here, maybe it invites Amit to jump into this as well, but at some point, the volume of capital that's going to be required for this build out is going to exceed domestic debt capacity within India, and that raises the question, as has been raised many times before, about what will be the sources of complementarity with foreign capital, particularly some of the debt infrastructure funds. Be interested in either of your view on how that's evolving, and particularly some of the risks that have, we've gone through a period now of fairly sharp depreciation of the rupee against other currencies. So that's, that raises an issue about how foreign banks would do that. They're also under a lot of pressure from, let's say, Basel III regulations to reduce the length of their lending on project finance and infrastructure. It's kind of full stop. So this is, it's not unique to India, but interested in your views on what's a sort of a pathway by which foreign debt capital can become complementary to domestic sources.
Right, Charles. As you rightly mentioned, for 100 gigawatt solar goal, we would need at least $85 billion, and India doesn't have this kind of money. But there are a lot of international equity and debt players which have set up shops in India, CDPQ, CPIB. So a lot of pension from Australia, Canada have set up shops in India and have invested major equity investments in leading companies, including Amplus. I know Shell Foundation has invested in Cleantech, and Petronas has invested in Amplus. There are a lot of investments already happening. There are debt players as well, which are coming to India to look at, because India can offer the scale, first of all, at 100 megawatt or 500 megawatt level, which other countries cannot offer. India also politically is much more stable than other countries. We have a stable government in central government, which gives a lot of comfort to these international investors. This is the positive part. On the negative part, as I briefly touched upon in my presentation, there are some things happening on the ground which is scaring the international debt and equity players. What happened in Andhra Pradesh last month is a significant setback to the renewable energy industry in India. On the safeguard duty, also things are not looking good from that point of view. So these are the policy changes which Government of India will have to step in if they still want to see and continue investment coming over there. One just very quick example: in the current budget, taxes were increased on income tax and for the large investments. So there was some confusion on that. Immediately the next day, a lot of FII and FDI players pulled out the money from India, giving the share market nose dip and also hit the renewable energy sector. So unless we plug these loopholes on the policy side, we won't see the kind of investment that is required for the Indian infrastructure, especially renewable energy sector.
Great, thanks for that. Vikas, would you like to add anything to that?
Yeah, so I mean, rightfully, I think the concerns I also share. This is one sector which has been growing at a very, very impressive pace since last 5 years, and we have a good visible target in sight. And if we have to continue going forward, I think we need to tackle these speed bumps because a lot of things are dependent on investments, and as Amit mentioned, I mean, domestic investments may not be fully available to achieve these targets. So we need to understand, how things affect international investments and how international investors perceive things. I mean, there was a lot of work done in the last 6 to 7 years, making them understand how the Indian power sector is functioning. How discoms, even though their financial profiles are stressed, how it will be beneficial and how it will be different for the renewable energy sector. So probably a sense needs to prevail on that front, and obviously there's a requirement of a balance on both the sides. But while India is moving forward to the 5 trillion economy, I think these are some certain smaller aspects where, as a country, we need to also give importance that the contractual arrangements and the way we enter into contractual arrangements, there cannot be scope for something like this.
Yeah. Good. Let me just ask you a very simple, practical question that came up in the chat, and then maybe I'll move on to something a little that's coming up now, maybe a bit more conceptual. So just in a very practical sense, if I'm a commercial or industrial player in India today, and I'm thinking about putting something on the roof, and I wanted to avail myself of the lending facility that's been made available through SBI Capital Markets, who do I call? I mean, where do I go into a local branch? I mean, how does this actually work in terms of making the first inquiry about taking a loan through that program?
Finally, Charles, you've given me an easy question after grilling me for the last 1 hour, but I'm happy to answer that question.
Okay.
So very easy. You can do several things. Go to the SBI website. There is a list of numbers for every region, which you can call, number one. You can go to your branch and you can ask about this loan. SBI has designated several regional banks in every state. If your branch is not an authorized branch, he will connect you to the nearby branch, which is the authorized branch as well. This list is also available on the website. Thirdly, which I don't recommend, if you have any customer, ask him to send me an email. I will connect you to the relevant player.
Perfect. That sounds great. And then the more conceptual question, and again, this is probably for both of you. You know, if again, in that thinking through those very early stages of putting together a proposal and thinking about, you know, whether what's the right way to go, maybe you could both just give us kind of the, the short list of key issues that come up from the lender side. What are the red flags that come up for them when they're thinking about whether a project that's being presented to them is indeed bankable, and maybe just some of that initial due diligence that folks would need to expect in terms of the lender getting comfortable that the project being presented to them is one that indeed is debt financeable.
Sure. I think from the lender's perspective, I can point out in terms of the decision factors as was there in the question also, that with the lenders that I have been, they are very, very open in terms of discussing projects and proposal with the developers. So the factors that mostly affect them is that, to understand where things can go wrong in the long term, because these are debt lenders with the horizon of more than 5 years and 7 years, in comparison to, construction time lenders or, construction financiers. So they have a long-term view on the asset, and they really want to understand from the developers not only the project strengths or the usual data facts which are available anyways, but what can go wrong, what as an equity investors you have also considered as a long-term risk factor in the project, and how that can be mitigated, right? So I think a clear picture on that, a presentation on that, whether it be a land issue or whether it be a counterparty issue in terms of PPA off taker, how you have analyzed those situations and what kind of a contractual comfort you have. I think a good presentation on that part really kicks in a relevant discussion with the lender. And it applies both to utility scale financing and the commercial solar rooftop, pooled asset kind of financing. From the developer's perspective, I think it's very simple in terms of the cost of capital and the IRR the project has the potential to give, with some understanding on what kind of debt terms and debt tenure that will be available. I think that forms the key, because if a project is from the beginning it looks like it is not bankable, then whatever IRR you can assume in your model, that may fall flat, right? And so initial estimation of what kind of debt financing for this project will be available, I think that need to be built up in the IRR models, and a fair expectation of the transaction cost also, as was mentioned earlier. A lot of time rooftop development shows up unexpected costs, and you have to build up certain buffers to keep that into mind also. So a fair idea on the IRR basis these sectors, I think that are the key points to look for in the developer side.
Great, thanks. Amit, anything would like to add to that? The key checklist from the lender's perspective of big issues?
Very quickly, as a lender, I want my money back. So the off-taker risk remains the big risk in India. All the discoms are in red. Their balance sheets are very weak. So when I lend for a solar park or a solar rooftop, I want to see if a discom of that state can give me back my money, because we have seen in Tamil Nadu, Andhra Pradesh, Maharashtra, there is a delay of 6 to 9 months. So that is not good for a lender. That remains. Secondly, as I mentioned, the knee-jerk reaction of Government of India and several states in moving from one policy to another is not a good sign for a lender like SBI and World Bank.
Great. I'll just add to that because it kind of reinforces some of the material that we had put on this week for the course. Is that, you know, one of the things that we always kind of encourage folks when they're thinking about asset financing that's not going to be coming entirely from the balance sheet of the company involved, is to really think about the whole process in reverse. And that is, you know, to think about what happens in bankruptcy, because clearly this is what lenders go into any situation preoccupied by. You know, that they are entirely a different animal relative to equity investors, in the sense that they see absolutely none of the upside from a project, and the only way that they get their bonuses is to make sure that every loan that they have committed ends up being paid in full and on time. So there's really one of the challenges in this, and this goes across, you know, a lot of the courses that we do in the business school, but it's just really trying to encourage people to think about this fundamental division in terms of risk appetite between the equity investor and the debt investor, and knowing that no matter how high the IRR or how exciting the project or how much potential upside is, that really matters nothing to the lender, and the lender is going to be consumed with analyzing credit risks that occur all throughout through the chain of the project. Amit just mentioned offtake risk as being probably the primary one, but that will go all the way around the chain to those that, you know, whoever's involved in O&M, who's involved in the EPC contract, any kind of ancillary services. So it can be a useful exercise in thinking through at the very start what the perspective of the lender is, and that's entirely in some ways 180 degrees reverse from what the equity investor is, and to just make the point again clearly, it's really a preoccupation with what would happen if the project was unable to meet its debt payment, and are there sufficient counterparties there that recourse can be sought from. Good. I think we've covered a lot of ground. I'll just say one more comment to kind of round up that we didn't get to all of the questions there, but it was really related to this issue of what are the costs of additional power flows and whether policies will need to change. And so we're already seeing, let's say in the US in particular, a lot of states that originally had net metering laws backing away from those now as the amount of renewables flowing on, or the amount of intermittent power that's flowing onto the grid gets higher. The logic of net metering starts to erode, and really the thing that has to take its place is some kind of time of day pricing. And this is the conceptual shift of a power system that's dominated by renewables is really one that says that base load is really becomes a secondary driver for system reliability. It's really about what it needs to be into the system that can be dispatched quickly, that's flexible, that can start to make up for periodic drops of power from either your wind farms or your solar farms or whatever it is. And clearly, storage is part of that solution. But for example, in the UK, Imperial College has done a lot of work at looking at what are the system costs associated with intermittent renewables, and up to, let's say, 50% renewables in a system. It's clear that it is best for the grid operator to manage those costs. That those costs are somewhere $10 a megawatt or megawatt hour or less, and so it's economically more efficient for the grid operator to make changes on their side. But as you get to higher levels, then clearly you need more and more you need more and more dispatchability from renewable generators. And so that's why you see so many projects now around the world going in that are hybrid projects, which have some amount of on-site storage. At the moment, that's mostly takes the form of lithium-ion batteries, but that will begin to change as the need for the size of the storage facility to grow. So, this is an issue that we've touched on here that really every market is trying to figure out, which is how much of the power that's coming from renewables should be firmed, if you will, meaning made dispatchable or made storable by the generator, versus how much of that should just be managed and dealt with by the grid operator. And again, there's a technical study that needs to be done there to know kind of at what thresholds those system costs start to go beyond a point at which the grid operator can kind of manage them efficiently. We're running out of time here, so I'll just say thanks to both of our speakers. Very interesting stuff. We'll make these slides available as we have for every session. And just to look ahead into the next, the fourth session, we'll take a break now here for a week. I know that there's a holiday coming up in India, so we've put a pause in the schedule. And we'll come back in 2 weeks, really to try to wrap up a lot of the issues. The fourth and final live session will deal a lot with the group assignments and how you'll be working with other folks in the cohort in order to pull that together. And finally, we'll be looking at some research that we're doing actively right now on the Indian market and looking at what are the drivers for corporate procurement and for other forms of incentives for renewables. And we look forward to sharing some of that work that we've been doing with you. I'd say it's a work in progress, but in a couple of weeks' time, we should have some very interesting things to share.
Great. Thank you, Charlie, and thank you, Vikas, and thank you, Amit. I think this was quite an engaged conversation that we had, and it was, of course, the structure was very different from the previous sessions. And I mean, I like attending finance classes for a long time. And I've been going back to university every 10 years or something. And it always happens with me. As soon as I step out of the class, a couple of questions always occur to me. Oh, I should have asked that, definitely, all that. So should any of you be in that kind of a position, I mean, I would urge you, feel free to just post your questions either on the discussion board or on the WhatsApp, and we'll try and forward these across to the speakers, and we will see if we try to address them as much as possible. So with that, thank you very much. There's a break next week, and we will see you on the 21st of August for the last live session. Thank you.
Thank you, Charles, and thank you, Naveen. Thank you. Thanks, Shubham.
Bye-bye. Bye-bye.
Bye.